Hi, I'm Chad Castle. On this video, I'm going to tackle the number one concern we hear from our clients when it pertains to permanent or cash value life insurance, and that's the topic of fees and expenses. When people decide to research whether or not they want to buy something, most folks head to their favorite search engine to see what the vast knowledge of the internet might have to offer. I've done this very thing when I wanted to fix a problem with my phone or when I wanted to check the prices for a beach condo. I've even searched for answers to some important medical questions that I've had. Now, what's interesting about the last fact is that both my brother-in-law and father-in-law are general practitioners. Combined, they've been practicing medicine for over 50 years. You would think that if I truly had an important medical question, I would go to them first. But in today's age of technology, we all find it very convenient to just jump on the internet and form an opinion of what is good or bad. The picture below was seen on a friend's wall on Facebook. He's a doctor, so I'm sure this is a funny sight in his office. But it's also a result of the vast amounts of misinformation that we can find on many topics on the internet. When thinking about the purchase of a life insurance contract, many people, just like they do before going to the doctor, try to self-diagnose their need for a policy. And when they jump on the search engines, they will typically find the same number one argument against insurance that has been touted for years by Wall Street and the investment advice industry. It's too expensive. Well, as both a licensed insurance agent and a registered investment advisor, I can tell you for certain that insurance contracts are expensive. However, most folks don't research far enough to determine that no matter what type of financial product you're looking at, they're all expensive. So the real question should not be whether or not insurance is expensive, but rather, is the insurance contract expensive compared to other financial products? If you'll allow me the privilege to run through a few examples with you, I think you will find, like I did, that life insurance is actually a bargain compared to most other financial products. So, before we dive into the actual fees and expenses of your overly expensive life insurance contract, let me ask you this. How much do you pay in implicit and explicit fees on your IRA and 401k? I'll bet you didn't even know there were implicit and explicit fees. What do you pay in advisor, administrative, custodial, and legal fees to the folks that handle your employer's 401k plan? I bet you didn't think that you paid for any of those fees. What about the taxes that you'll pay when you remove the money from your IRA or 401k? Ever thought about the future tax liability that is built into the value of your current retirement account? For your non-retirement accounts, have you ever calculated the annual tax costs of the 1099 that you receive? Do you know what the account costs you based upon the portfolio manager's turnover in the account that ultimately produces interest income taxes, dividend income taxes, and capital gains taxes? Do you know how these taxes will continue to go up as the account grows and compounds in value? Obviously, I'm trying to make a point here. And the point is this. Most people have no idea what the total costs are on the current financial product decisions that they have made and are making. But because my CPA said a 401k would save me some tax and Money Magazine said it was a good mutual fund to buy into, we believe the hype with very little request for details. Because these types of financial products have become mainstream, the public pours money into them with little regard for the details. But as soon as someone mentions life insurance, let the Google searching begin. For comparison purposes, let's first think about the time frame in which a life insurance contract should be judged. For example, most folks will judge their IRAs and 401ks based upon the long term. A perfect example is when the market pukes 20% or more and you call your broker or investment advisor and they tell you not to worry about the decline because we are investing for the long term. Let me pull back the curtain and be really honest with you here. As an investment advisor, the phrase long-term is code for, I hope my client will stay with me long enough for the market to recover. Now, fortunately, the market has always recovered, but the point remains the same in that we are conditioned to invest our retirement accounts over the long term. But when it comes to life insurance, the first negative that people focus on is the short-term expenses in the contract. You see, life insurance is built, at least the way that we built it, so that the majority of the contract's fees and expenses are charged during the first 10 years of the policy. After 10 years, the annual expenses of the contract go down significantly, and the policy will improve its internal rate of return each and every year. In a traditional investment like a mutual fund, just the opposite happens. The fees and expenses are small at first, but as the account grows, so do the fees and expenses, as well as the negative tax consequences of the account. You can think of the fee difference like a triangle versus an inverted triangle. That's maybe the best way to picture it in your mind. On an investment account, the fees are very small in the beginning, and they get much larger as the account grows. On the insurance contract, it's just the opposite. The fees and expenses are very high up front, but get smaller and smaller as the account has a little more time under its belt. But practically speaking, when is the best time to pay for the largest portion of expenses on your account? Is it best early on while you're working and can afford to pay the expenses, or later in life when you're needing to reduce the expenses in order to retire? Now that I've given some lip service to the discussion, let's take a look at some real numbers. Below, you'll see a chart that reflects a client who pays 15% average tax rate. This client also pays 1.25% in fees and expenses on his investment portfolio. By most any reasonable comparison, this is a scenario that is pretty conservative and tilted in favor of the investment account. Nevertheless, notice that in year 7 of the plan, the annual expenses of the IUL become less expensive than the investment account. Then notice in year 13 that the cumulative fees and expenses of the IUL are now cheaper than what the client would experience in their current investment account. And for every year after year 13, the IUL becomes more and more of a bargain compared to what the client is currently doing. Plus, the IUL expenses are taken into account the cost of the insurance and everything else. Now, take a look at year 20. The investment account is double the cost of the IUL and then triple the cost of the IUL in year 30. So, in conclusion, is life insurance expensive? You bet it is. But compared to a typical financial solution, it's actually a way better value. Look, even if you don't have a long-term time horizon, there are other options out there that will be a lot less expensive than a maximum funded permanent life insurance contract. I hate to spend money when I'm not getting a good value. All life insurance is expensive. Some would even say that it's offensively expensive during the short term. But the products I personally use allow me to minimize my expenses, and I can even see exactly what the expenses are. Bottom line is that I'm willing to pay for performance when I know exactly what I'm getting for it. And I'm more than willing to pay for what I want. And what I want is a whole lot different than what the financial entertainers out there are telling me that I need. I want the ability to use my policy as collateral, tax postponed growth, tax-free access to cash values, a guaranteed place to borrow money at a guaranteed interest rate, to know my family is protected if I die too soon, to minimize the effect that inflation may have on my retirement income, to minimize interest rate risk, the ability to self-complete if I become disabled, a floor for my assets, predictability. I want to know that the strategy I'm using is going to work. I may sound like a spoiled teenager with all of the wants, but what I am is a licensed and trained financial professional who has actually taken the time to read contracts and study, and one who is willing to provide facts instead of offer opinions. I'd like to offer you one final thought before we part ways. We spend a great deal of time preparing a free report that will give you 20 smart questions you need to ask your financial advisor before you ever give them any of your money. You can get a copy when you visit our website at indexeduniversallifeexperts.com. I appreciate your attention today, and I look forward to talking to you again.